What if a financial institution told you their latest profit numbers weren't just, digits on a spreadsheet, but the validation of a dream coming true?
That's quite a statement.
It really is. And that's exactly where we're starting today. We're diving deep into the Q1 FY26 results of SBFC Finance Ltd. They're an Indian non-banking financial company, an NBFC, specializing in small business loans.
Right. Really interesting segment.
Absolutely. And our mission today is to look past those, impressive headline numbers you might see in their earnings call or investor slides.
Go beyond the surface.
Exactly. We want to unpack the broader economic currents shaping India, the specific strategies SBFC is using, and maybe some surprising realities of finance on the ground level.
Sounds good. There's usually a lot going on beneath those big numbers.
Get ready for some real aha moments, hopefully leaving you truly well informed.
Let's do it.
So, okay, we kind of have to kick off with their headline numbers because, well, they are pretty exceptional. SBFC Finance reported a profit after tax, or PT, of 101 crore rupees for Q1 FY26.
That's a solid number. 101 crore.
Right. And like we said, it's not just a number on paper for them. They explicitly called it the validation of a dream coming true.
You don't hear that kind of language in financials every day.
You really don't. Think about it. They've grown from achieving this annually, then maybe half yearly, and now hitting this scale quarterly. That's a serious milestone for any company.
It truly is. And the underlying figures really back that up. That PT, that 101 crore, represents a significant 28% growth year on year.
28%. Wow.
Yeah, and 7% compared to just the previous quarter. Plus their assets under management, or AUM.
Which is basically the total loans they're managing, right?
Exactly. That also saw really substantial growth. It hit 9,351 crore rupees.
Right.
And that's a 30% jump year on year and 7% quarter on quarter. These figures, they clearly signal a financial institution that's not just healthy, but really expanding its footprint and impact pretty rapidly.
Okay, so let's unpack that. What's actually driving this? What's fueling the growth? And, what larger economic forces are they dealing with right now?
Well, the company's leadership pointed to what they called four good things, sort of tailwinds helping them along.
Four good things. Okay, what are they?
First, they mentioned extremely good monsoons. Apparently, it's been a continuous cycle for 2 or 3 years, and this time it started early.
Right. Crucial for India's economy.
Absolutely. Second, the fact that there's no income tax on income up to 12 lakhs rupees, that's a big boost for a lot of people.
Leaves more money in pockets.
Precisely. Third, borrowing rates have generally been coming down. And finally, inflation is falling.
So when you put all that together, for you listening, these things generally mean, well, more disposable income, right? Which can really get the economy moving.
That's the idea. But it's definitely not all smooth sailing. There are some pretty significant headwinds they're also navigating.
Okay, what are those?
We're seeing sort of widespread income stagnation and a worrying slowdown in job creation. This is particularly hitting urban consumption.
Urban consumption is weak. Why is that?
Well, large employers, think about big banks, IT services companies, they seem to be in a serious cost-cut mode.
Ah, okay. Belt tightening.
Exactly. And what's particularly striking, and maybe a bit concerning, is this growing global trend of educated unemployment.
Educated unemployment. Not just in India.
No, globally. It seems linked to a mix of things. AI adoption taking over certain tasks, slowing economies in general, uncertainty around trade tariffs. It's complex.
Right.
Now, here's where it gets, I think, really insightful. The company's management, based on their own travels, they mentioned crossing states like Karnataka, Andhra, Telangana, Maharashtra, UP, Bihar.
So really getting out there.
Yeah, boots on the ground. And they made this fascinating observation that India is growing outside of its metros.
Outside the big cities. Interesting.
Yeah, it challenges that conventional view that growth is all about Mumbai, Delhi, Bangalore. They're seeing real dynamism, it seems, in semi-urban and rural areas. A surprising resilience.
Okay, that's a really counterintuitive point. You'd normally think, okay, if rural India is growing, then sales of everything should be booming.
You would think so.
But here's the twist they pointed out. Despite this growth they're seeing outside the metros, they also said that the growth in sales of all discretionary consumption companies has been anemic.
Anemic, huh? So
Yeah.
weak sales for things people don't strictly need.
Exactly. And the reason? It seems the quality of purchasing power in rural areas while growing just isn't the same as in the big urban centers. People might have a bit more money, but maybe not enough for those big ticket discretionary items.
That's a crucial distinction. So economic activity is up, but maybe not translating into the kind of robust consumer spending that drives certain sectors.
Precisely. It's a different kind of growth.
And if you connect this to the bigger economic picture, this combination, you've got weak consumption overall, poor private investment, government spending kind of maxed out, rising imports, plus all this uncertainty around exports with the tariff situation. Well, it is a drag on India's overall GDP growth.
So the numbers reflect that.
They do. Looking at the specifics, private consumption, which is like 60% of India's GDP, it's huge, actually dipped 2% last quarter.
Wow.
And exports were down 4%. But there's a strong counter trend. Investments are sharply up by 9%.
Okay, but where's that investment coming from if private investment is poor?
Mostly government spending. That's been the driver there.
Mm.
It's also really important to remember the context of monetary policy. The Reserve Bank of India, the RBI, had deliberately tightened things up before.
Right. They hiked interest rates quite a bit.
Exactly. By 250 basis points, that's 2.5%, and kept liquidity tight. It was a deliberate move to slow growth down and tackle inflation. And it largely worked on the inflation front.
Yeah.
Now, the cycle seems to be shifting. We're starting to see signs of an easing cycle beginning.
Okay, shifting gears a bit. Think about, your neighborhood shops. The local grocer, maybe that street food vendor you like. What's happening to them, especially in the bigger cities?
Yeah, that's a really important ground level view.
Well, the company, SBFC, had a pretty stark observation. They said, quote, Wall Street and Dal Street are eating real street's lunch in urban markets.
Dal Street being India's Wall Street, essentially, the financial markets, big corporations.
Right. So they're saying the big guys are squeezing out the little guys in cities. And this includes, everything from the giant e-commerce platforms and direct-to-consumer websites to those quick commerce delivery services and the big organized retail chains.
Yeah, the competition for traditional local businesses is just immense in urban areas now.
They're all taking a significant bite out of that business. It feels like a fundamental shift in how people shop and how commerce works in cities.
It's a profound change, absolutely. And that raises the question, how does a company like SBFC, lending to small businesses, navigate that kind of disruption?
So what was their response?
Well, this is where their strategy seems quite prescient. They apparently could see this coming way back when the company was founded.
Really? From the start?
That's what they indicated. So from day one, they made a very deliberate decision. They decided to focus on small businesses, yes, but specifically in smaller towns, and to actively stay away from metros.
Ah, so they deliberately avoided the battleground where Wall Street was eating Main Street's lunch.
Exactly. They chose to build their business in areas they felt were less susceptible to that specific pressure. And now that proactive decision, that focus on non-metros, seems to be playing out just as they envisioned. It really validates their new strategy.
Okay, so that explains their focus geographically. But what happens when the broader economic climate gets rougher? You mentioned the RBI tightening credit before.
Right, when the taps of credit tighten for everyone.
What did SBFC observe then?
Well, they noted that the RBI rightly saw a bubble forming and pricked unsecured and microfinance lending. That was the specific target.
Okay, so the RBI stepped in to cool down those specific areas.
Yes, but the effect was broader. It caused other lenders, even those not directly in unsecured or microfinance, to become much more cautious, to recoil a bit.
Ah, the ripple effect.
Exactly. And when that happens, the velocity of money drops, basically. Money just doesn't change hands as quickly in the economy. It slows things down. And that, as they pointed out, always has unintended consequences affecting even borrowers who weren't initially part of the concern.
So even good borrowers might find it harder to get loans or conditions get tighter.
Precisely. And this leads us to, the crucial question.
Yeah.
How do you manage your own credit risk when the whole environment is so unpredictable?
Did they face specific challenges?
They did. They mentioned a specific political risk that played out in Karnataka. There was an ordinance passed, apparently unrelated to SBFC's core business, but it sharply brought down their loan collection numbers for a whole quarter.
Wow, just like that.
Just like that. And their observation was quite telling. While damage takes a quarter, its repair takes away the other 4. It really highlights how quickly external shocks can hit and how long recovery can take.
So it makes recovery slow.
Very. They also noted a critical trend in the market. The need for finance has gone up, so businesses still need money, but the demand defined as need plus ability to pay the EMI has reduced.
Meaning fewer businesses who need loans are actually in a strong enough position to reliably pay them back.
Exactly. And that directly led to a 10% increase in their own loan rejection rates. They're becoming more selective.
So what's their core strategy for managing this risk?
Their mantra seems to be fortify our balance sheet over profit and loss. Basically, prioritize financial strength and stability over maximizing short-term profit.
How are they doing that specifically?
A couple of key things. They actually stopped accruing interest on non-performing assets, or NPAs, 2 years ago. That's quite conservative.
Meaning they don't count potential interest income from bad loans until they actually receive it.
Right. And they're actively raising their provision coverage ratio, the PCR. Think of it as their cushion against potential loan losses.
Yeah.
They're aiming for double the regulatory minimum. Right now, it stands at 44.4%,
So building a really strong buffer.
a very strong buffer. They also maintain almost twice the required amount of liquidity, readily available cash. They explicitly call this a price we will happily pay for a good night's sleep.
I guess that makes sense in uncertain times. Peace of mind.
Definitely. But this commitment to strength has a cost. They are increasing their loan loss provisions, which they expect will add about 15 to 20 basis points, that's 0.15 to 0.2% to their credit costs going forward from Q1's 1.11%.
So slightly higher costs baked in for safety.
Correct. Now, what's particularly revealing is the link they've found between credit stress and the size of the loan, the ticket size.
Oh, what did they find?
Industry data, they said, shows that MSME loans, that's small and medium enterprise loans under 10 lakh rupees, saw a significant 70 basis point deterioration in performance. So the percentage of bad loans went from 5.1% up to 5.8%.
Okay, so stress is higher in the smaller loan segment.
Definitely. In contrast, larger ticket size loans either improved or only worsened slightly. This tells a story, right? It suggests that, as they put it, prime credit Indians are doing extremely well.
The borrowers with stronger profiles and maybe bigger businesses are okay.
Generally, yes. But as we go down the ticket sizes, there's a stagnation of income and a pressure on ability to pay. That's where the strain is showing.
That's a really granular insight.
It is. They also acknowledge the challenge of hand loans,
Yeah.
informal loans people take from friends, family, or unofficial lenders. It's a gray area for the industry, but they try to understand it through personal discussions during the loan application process, because it obviously affects a borrower's total debt burden.
Right, it's part of the full picture. So, okay, after all these strategic moves, focusing on smaller towns, managing risks so carefully, what does this actually mean for their future growth? Are they pulling back?
Well, despite all these challenges and the cautious approach, the company expressed a clear sense of confidence, actually.
Oh, okay.
Yes, they are tightening credit filters for certain types of borrowers and in specific geographies, and they mentioned marginally moving up their average ticket sizes, perhaps reflecting that stress point we just discussed.
Makes sense.
But their large distribution network, remember this 215 branches, that gives them a huge advantage in maintaining momentum. They're still targeting a healthy 20% growth in the amount of loans they give out, their dispersals,
20% growth in dispersals.
which they expect will translate into an impressive 25% growth in their total assets under management, their AUM.
So still pretty ambitious growth target.
Absolutely. And an interesting sort of an enhancer to their business is their gold loan portfolio.
Ah, lending against gold. That's big in India.
Huge. And it's growing significantly for them, up 40% compared to the last quarter and about 37-38% year on year.
Wow, 40% quarter on quarter.
Yeah, rapid growth there. Now, it makes up about 13 to 14% of their total loan book.
So not the bulk of their business, but significant.
Right. But the key is it brings in higher yields. The return is about 3 to 4% higher than on their standard MSME loans.
I see. So it boosts overall profitability.
Exactly. They see gold loans as yield enhancers with minimal credit risk because you have the gold as collateral, though they do acknowledge it carries a higher operating risk. You need secure storage, proper valuation, that sort of thing.
Sure, makes sense.
And it's telling that 175 out of their 215 branches now offer gold loans. They're really integrating it.
Okay, what about efficiency? Are they managing costs well while growing?
It seems so. Their cost-to-AUM ratio, a key efficiency metric, actually improved. It dropped by 21 basis points year on year to 4.59%.
That's good progress.
It is. especially since they do have upfront costs for new branches. They mentioned 15 to 20% of their branches are less than a year old, so still ramping up. But despite that, they're sticking to a full-year target of a 50 basis point that's 0.5% reduction in operating costs relative to AUM.
So aiming for continued efficiency gains. And what about their own borrowing costs? If they're lending money out, they also need to borrow it first.
Good point. They actually anticipate a downward trend for their new funding costs. They see ample liquidity in the banking system and are expecting maybe a 100 basis point, a full 1% slide in the RBI's main policy rate, the repo rate, over time.
So they expect their funding to get cheaper.
They do. But in a characteristically cautious way, they're conservatively penciling in a flat cost of borrowing as a worst-case scenario in their planning for now.
Hedging their bets a bit, prudent.
Very. And this all feeds into their returns, their return on average tangible equity, or O8.
Which is basically how well they use shareholder money to make profit, right?
Exactly, a key measure for investors. That improved nicely to 13.53% this quarter. That's up from 12.3% a year ago.
Solid improvement.
Yeah, and it puts them firmly on track, they believe, for their longer-term target of a 15% return on equity, or ROE. They did note that their return on assets, the ROA, might slightly compress, maybe dip from around 4.5% down to 4.2 or 4.25% as they take on a bit more leverage, moving from borrowing 3 times their equity to maybe 4 times.
Okay, so ROA might dip slightly as they grow using more debt.
But the improving ROE, the return for shareholders, is their main focus.
Got it. And finally, collections. With all the talk of stress, how are they doing on getting payments?
They highlighted that they've invested heavily in their collection infrastructure.
Yeah.
They have over 550 people dedicated to collections across their branches.
Wow, that's a significant team.
It is. And they say these efforts are paying off. The rates at which they cure loans that are just starting to become overdue, say 0 to 30 days past due, bringing them back into good standing, those rates have remained stable compared to last year.
So their collection efforts are stabilizing things despite the pressures.
That seems to be the message. And because of all this, they're maintaining their business-as-usual guidance for AUM growth of 5 to 7% quarter on quarter.
Okay, so steady as she goes on the growth front, underpinned by all this careful strategy.
Seems like it.
We've really taken quite a deep dive here into how SBFC Finance is navigating what seems like a truly complex economic environment.
It's definitely multifaceted.
Yeah, from those big global trends like AI's impact and educated unemployment, right down to the very local realities of, urban versus rural consumption patterns in India, they're making very specific, very strategic choices.
Very deliberate.
And this focus on fortifying the balance sheet, prioritizing strength, even if it means slightly lower short-term profits, and really tailoring their whole approach to India's incredibly unique economic pulse. It's quite a masterclass in adaptability, isn't it?
It truly is a compelling picture. You see the adaptability, but also the foresight. Remember they said they saw that urban challenge coming?
Right, years ago.
And they intentionally focused on what some might see as the, less glamorous part of the economy, small businesses, small towns. But perhaps it's the more resilient part in some ways.
Especially now, it seems.
Especially now. And this is happening even as these big global shifts are impacting other sectors like tech services, maybe more directly. Their story really provides a granular view of how a company can potentially thrive by deeply understanding and proactively adapting to the specific nuances of its chosen market rather than just sort of following the herd or the mainstream trends.
A fascinating case study.
Definitely. So maybe a final thought for you listening. Considering this deep dive we've done into these quite granular economic shifts and these very targeted financial strategies, how might the success of businesses like SBFC, these businesses focusing deliberately outside the metros, how might that start to redefine our traditional indicators of national economic health?
That's a great question. If growth is happening differently, maybe we need different ways to measure it.
Perhaps. And what does that changing landscape mean for you, whether you're a consumer, maybe an investor, or just someone trying to understand the real pulse of a major global economy like India's? Something to think about.